Well, welcome everyone. It's great to see you all here today. My name is Tricia Weaver-Moss. I serve on the Board of Trustees here at Grace Cathedral. And this year I'm helping to lead our planned Giving Society, Circle of Grace. I'm delighted to welcome you to today's seminar, Leaving a Lasting Legacy. For our format today, we will have introductory remarks regarding planned giving at Grace, followed by a discussion about specific planned giving vehicles with a question and answer period at the end. I invite you to submit your questions at any time during the presentation using the Q&A button at the bottom of your screen. We'll see your questions and hope to be able to address them as time permits. And now it's my honor to introduce our esteemed panel of speakers who will explore today's topic. Catherine Thompson is the Chief Development and Communications Officer and Canon for Development here at Grace Cathedral. Since 2011, Catherine has served as passionate advocate of the Cathedral to advance the Cathedral's mission of reimagining church with courage, joy, and wonder. Among other leadership roles, Catherine oversees development here at Grace. Martha Detweiler is a certified specialist in estate planning, trust, and probate law. She is senior counsel with the law firm of Leland, Paracchini, Steinberg, Metzger, and Melnick, LLP. Martha has practiced law for over 30 years and focuses on estate planning for individuals and families, with an emphasis on achieving the client's personal estate planning and tax savings objectives. Martha's expertise includes revocable trusts, wills, healthcare directives, probate and trust administration, wealth transfer planning, and charitable remainder trusts. Martha graduated from Duke University and earned her JD at the University of Virginia Law School. Martha is a former member of the Grace Cathedral Board of Trustees. Tim Watson is also a certified specialist in estate planning, trust, and probate law. He's a partner at the law firm of Watson and Machado, LLP, where he advises individuals and families on creating comprehensive estate plans, looking at such issues as wealth transfer, family dynamics, planning for incapacity, tax planning, and administration of trusts and estates. He also assists executors and trustees in the administration of trusts and estates. He holds a BA from Boston College and received his law degree from the University of California at Davis. Tim serves as an advisor and board member to various nonprofit and religious groups, including Un Mundo and Puente a la Salud Comunitaria and the 19 for Life Foundation. Tim and Martha, thank you so much for lending your expertise to us today. Catherine, the floor is yours.
Thank you, Tricia, and thank you, Tim and Martha, for being with us. And thank you for everyone who's joined us today. We've wanted to have an event like this for a long time. And between Tricia and our wonderful annual giving manager, Elizabeth Leap, finally, we have realized something we've wanted to do and share. The Cathedral has always valued and benefited from the planned gifts that come our way from donors who are in our congregation and wider. It's always been important. The Cathedral uses planned giving for many different purposes. They're often given to us by donors. They support all kinds of wonderful things. And it's a real honor for Grace Cathedral to be able to accept these kinds of gifts. They're very special. They're usually very intentional, and they're often a way for donors to continue the values that they've had during their lifetimes after they're gone. So it's a really special kind of gift, and it's been an honor to accept them for many, many years. And they come in all kinds of ways, which I know that Tim and Martha are going to share with us, especially in the next several minutes. I always like to tell the story of one transformational gift for the cathedral. And it came to the cathedral in 2005 in an envelope in a staff member's mailbox when we learned that a former chorister from the 1930s, a chorister is someone who sings in our choir, had left us an apartment building, and the apartment building ended up being ours to sell, and we ended up funding a purpose restricted fund for the building after a sale that gave the cathedral several $1,000,000. So it was a really important gift, and it was someone that we didn't know was making the plan. And it was truly transformational to the cathedral when we were in a campaign and trying to raise money for these different funds so that we would have, greater endowments, greater funds to be able to fulfill our mission in the years to come. So that's one of our favorite stories about plan giving, and there are many others and others to come. And the way that we talk about plan giving is, as Tricia mentioned at the beginning of the meeting, and that's in this effort and this group that we call the Circle of Grace. A few trustees got together a few years ago and said, yeah, planned giving is terrific. The Legacy Society, we've seen that, but let's call this the Circle of Grace. And it really stuck. We have over 200 households in the Circle of Grace, and they're part of our family. Many of the members of the Circle of Grace are actually part of our of our congregation, are members of our board of trustees, and many of them connect to the cathedral for other reasons, either instead of being directly involved as cathedral members, and in addition to. So it's a wonderful and special kind of relationship. We want to have a more active and larger Circle of Grace. People join it all the time, but it's the more we share what it's about and how you can be a part of it and how your values can translate into something really special for the cathedral, we're hoping that more and more people will become a part of it, because, as I mentioned, it is so important to Grace. So I think that is, those are the opening remarks that I had, and I think it's back to Tricia and Martha and Tim to really talk about what we're talking about today.
Thank you so much, Catherine. Tim and Martha.
So thank you so much for having us here. Martha and I have really enjoyed getting to know all of you and getting ready for this presentation. So I think what we're going to do here is we're going to take the bulk of the time here to go back and forth between Martha and I, talking about various points about planned giving and estate planning and charitable giving. And then at the end, we'll have some time for questions. So the first thing I wanted to talk about is, what is the context for this discussion about planned giving? And I think the thing that Martha and I have in common is that we both work on people's estate plans. And so this planned giving piece is sort of a portion of that estate plan. It's part of that planning process. The primary reason people do estate planning and have these discussions with us is to provide for their loved ones, right? So the estate plan is where you set forth your wishes for what happens to your assets upon your death. And as part of that, like I said, there's planned giving, there's tax planning, there's some planning about end of life decisions. So it's a comprehensive discussion, but primarily focused on you and your loved ones. The piece about planned giving, and this comes up almost in most of the plans that we do, is also outside that family, outside those loved ones. Where do you want your assets to go? Who do you want to have benefit from that? And a lot of times we're talking about charities. Grace Cathedral is a perfect example of one of those charities. And so within the estate plan, we like to bring this up with clients and find out what is it that adds meaning to their life, and what is it that they're willing to or want to benefit upon their death. And then obviously one of the big things that we do in California, which is a little different than some other states, is we have people do living trusts to avoid probate. So living trusts, beneficiary designations, basically anything we can do to stay out of the courts. The courts were already a mess before the COVID pandemic, and now they're even worse. So big thing of what Martha and I do is to keep families from having to go to court if possible upon the death of a loved one. So with that, I'm going to hand it over to Martha, who's going to say a few words about the tax piece of this.
So one of the kind of overriding themes of all of these charitable gifts is the tax advantages. Probably most people think about the tax system as a way for the government to raise money, but it's also a way the government has set up provisions in the tax code to encourage some sorts of behavior. And one of the things it's really designed to encourage is charitable giving. So we're going to be talking a bit about the various tax advantage of the particular sort of vehicles and options we're talking about. But I wanted to first lay the groundwork for talking about taxes. There are three different kinds of taxes that come up in different contexts. One is income tax. We all know about income tax. We file our 1040 each year that reports the income we've made. Another important type of tax is capital gains tax. Now, this is a sort of income tax, but it's a tax that's imposed on capital gains or appreciation in value of an asset. And it only comes into play when an asset is sold. And then there's estate tax. And this is a tax that's imposed on an estate at the time a person dies. And this is a big type of important tax in the various vehicles we're going to be talking about. So the first type of giving vehicle I want to talk about is leaving a bequest as a designated beneficiary from your IRA or retirement account. Now, if you can think about your assets as having several different buckets, you've got your real estate, maybe you've got your investment accounts, and then you've got your retirement accounts. That is the most valuable asset to leave to a charity on your death, because the charity does not have to pay income tax when the money comes out of the IRA. When you contribute to your IRA, you don't pay income tax on it. So the basic rule is when the money comes out of the IRA, individuals who receive those distributions have to pay income tax. But since charities are tax exempt, they don't have to pay income tax. So it's a really valuable type of asset to leave in a beneficiary designation form to a charity. You can leave a percentage to charity and a percentage to your family or other people. And it's also a way to make a charitable gift without having to go through a lawyer or any sort of complicated mechanism. You merely fill in a beneficiary designation form, which can be provided by the administrator of the retirement account. So I'm going to turn it over to Tim now to talk about another fairly straightforward way of making charitable gifts.
Yeah, that's a good segue. We, a lot of times when we do these presentations or when we're sitting down with clients, we talk about all the different ways that you can do charitable giving and your planned giving. And a lot the simplest way, what Martha was just talking about, is just changing your beneficiary designation on your retirement account, or what I'm going to tell you about, which is just adding a bequest, a simple bequest in your will or in your trust to the charity. We get very complicated from there very quickly, and a lot of times the simplest is the best, right? That's the most common and easiest way to do charitable giving. And so when you're thinking about updating your will or your estate plan, or if you haven't done one, doing one for the first time, I would encourage you to think about a couple of ways to do charitable giving. The most common way is to say, I want this amount to go to this charity. We call that a pecuniary bequest. So you would say, an X dollars to go to Grace Cathedral. That's like by far the simplest way that we do the charitable giving. You can also do, a lot of times people have specific assets in mind, right? So they know that they want, for example, their house to go to their kids, but maybe they have some other property or some other asset. They say, hey, I'd really like this to be set aside for charity. So we see that a lot too. We call that a specific bequest of a particular asset. And then lastly, what we have is remainder bequests. So we call those like percentage bequests. That is usually after all of the other bequests have been made, after all of the expenses have been paid, what is left over? And typically we set that up as shares or as percentages. So the way that would work is you would say, a common thing that I see some of my clients do is they say, everything goes to my kids. So maybe 90% to the kids and 10% to charities. And then they break up their charitable giving that way. All of those are acceptable. All of those are easy to do. Those, though, unlike what Martha was talking about with the IRAs, that does usually require going to a lawyer to update the estate plan or to draft the estate plan. There's some tax provisions and some things that you want to make sure are in there. And then you also want to make sure that it's clear. I'm involved in a probate right now where the person had a bunch of bequests to individuals and then a bunch of bequests to charities, and it's not clear from the writing of the will who pays the expenses. It's a very large estate. The expenses are going to be significant, and typically those expenses come out of not of the charitable share, but out of the other piece. And in this case, it's not clear. There's some language indicating that intent, but it's very important to go to an experienced estate planner to avoid those kinds of issues down the road. So with that, I'm going to pass it back to Martha to talk about some of those more advanced giving opportunities.
Well, I'm going to talk about a gift annuity, and this is really not very advanced. You can do this on your own, working with a charitable organization. It's a way you can make a gift now to a charity and get back a stream of payments for either your lifetime or for a period of years you designated. And the Diocese of California maintains or can accept charitable annuities. And the minimum amount for those gifts is $10,000. The amount you get back and the tax benefit you get is a matter of kind of a complicated formula depending on a lot of factors. One factor is your age at the time of the gift. And maybe at the end of the talk here, Catherine could give the website information for the diocese, which has on its platform tools that you can figure out. If you leave X amount and if you're $Y, your Y age, what will be the tax benefit and what amount could you expect to get back? So another kind of simple, straightforward way to give a gift, this is called a split interest gift, and we'll use that term some more, but because the interest is being split between you, who can continue to receive an annual payment or an annuity, and the charitable organization at the end. So another way to avoid lawyers, which most people don't mind doing, and avoid the problem of ambiguity. I think we can't stress that enough, that just something that you write when you're clearly thinking about something may not read the same way when you're gone. There may be ambiguity. So that's always, if you've got any sort of complicated gift, always a good idea to have some experienced practitioner involved with writing it down. So Tim, do you want to talk about some more complicated?
Yeah, and I think the other difference is, we kind of shifted from talking about, charitable gifts at death to charitable gifts during life, right? So typically the gift annuity is something that we do during life, as is what I'm talking about, which is the charitable remainder trust. So this is another, it's very similar to a gift annuity. This is where you would, if you have an asset that is highly appreciated, so there's a lot of built-in capital gains usually, And if you sold that asset, you would pay capital gains and you'd be left with the after-tax proceeds. We have some clients who say, well, I really want to give to charity, but more importantly, I want to sell this asset. I just don't want to pay the taxes on it. And so one thing that you can do is take that asset, you set up a charitable remainder trust, and you donate that asset to the trust. The trust then sells the asset. There's no taxes due when that trust sells the asset because the trust itself is dedicated to charitable purposes. But the trust pays you back an annuity. It pays you back every year, either a set amount, a value of the assets, like a percentage of the value, or a set annuity. Sometimes we set them up as income trusts, so they pay the net income from the trust. They can be set up a number of different ways. But the primary thing to think about with charitable remainder trust is after the remainder, so after the lifetime beneficiary passes away, whatever's left goes to charity. And generally, it's a charity that you've selected up front. Sometimes people will name a donor-advised fund, which is also a form of charity, like a community foundation, and then they get their kids to or trustees to nominate the charities after they're gone. You can name multiple charities. It doesn't have to be one, but normally it is done with one charity in mind and maybe some other ones tacked on there. The benefits of doing a charitable remainder trust, again, are you can take that value of that appreciated asset and not have to pay taxes on it right up front. So you only pay taxes as the trust makes distributions to you, and you're just paying a portion of those distributions, tax on a portion of those distributions. So you get an upfront tax deduction when you set it up, which helps you offset other taxes that you might be paying. So it's a complicated structure, but it's a very a hugely tax beneficial structure. You get an income tax deduction, you defer the income tax capital gains on the sale of the asset, and then at your death, whatever's remaining goes to charity. So none of those assets are included in your estate when we're talking about estate taxes. So it's a really great vehicle for estate tax planning and income tax planning and charitable giving. I think Martha mentioned to me before the call that the diocese also has a calculator on the website for charitable remainder trusts, and it'll help you work through some of those calculations. And they are looking for, I think, a minimum of $100,000. These are a little expensive to set up and manage, and so that's why you have a little bit of a higher minimum for those. But anyway, those I find that when we do these talks, the majority of the questions we get are about these charitable remainder trusts. These are very popular and very I don't want to say easy to set up, but they're relatively common vehicles that we set up. So I'm going to pass it back to Martha to talk about a less common but very interesting and good charitable giving vehicle called the Charitable Lead Trust.
So the Charitable Lead Trust is a very similar vehicle, but if you can just think about the interest being switched. In a charitable lead trust, the charity gets an annuity or a stream of payments for a period of years, possibly your life. And then at the end, your kids or whoever the beneficiaries are get the remainder. Now, this is sometimes referred to as the Jack Vanessa's trust because she actually set up a very complicated charitable lead trust. The trust in her case was to be established at her death. It was to last for 24 years, with the charities getting, as in this case, a fairly large stream of income for 24 years. And then at the end of that period, the money went to her two kids. So the spoiler alert, even with this very complicated trust structure, she gave her children the option at her death to accept the money right then, rather than to set up this lead trust. And they took that option. They decided they wanted the money right then. And so this wonderful tax planning, which would have not only saved money, it would have put a lot more money, it would have actually put more money in the hands of the kids and given a lot of money to charities. It never came into play. So, but it's still a useful vehicle, because a lot of people can't get rid of the idea that they want to leave money to their kids when they die. But in a lot of cases, your kids have plenty of money while you're alive. So this gives you the several tax benefits, one of which is just getting the money, the gift out of your estate. So it's not going to be taxed as part of your estate tax. And you are benefiting charities for whatever period of years you set up. So there's several other types of assets that are beneficial for gifting and charitable gifts, and Tim's going to talk about those.
Yeah. So the types of assets that we typically think about when we're doing planned giving or charitable gifts, obviously cash, right? Cash is the most common and easiest one. You write a check, you send a wire or whatever it might be. But there's no fun in that. We don't get to have fun estate planning conversations about that. So the other ones that people are often looking at are anything that has appreciated, like I mentioned with the charitable remainder trust. So things like stocks that may have gone up in value. Real estate is another one that we see typically. And again, with real estate, one of the things to keep in mind, a lot of people are reluctant to maybe give an entire piece of real estate to a charity. So a lot of times we will separate out a percentage of the real estate to charity. And the biggest mistake I see people make both with real estate and with stock is they sell the asset first and then they make the charitable gift. They go, oh, they sell the asset. They say, oh, I'm going to have a huge tax. And then they make a charitable gift after to help offset the tax. It's much more efficient and you're going to come out much better in the end if you instead give the portion to charity first before you do the sale. So give stock to the charity first and have them make the sale. And again, the reason for that is if you take, say, $50,000 worth of stock and you sell it, and then you take the after-tax proceeds and give them to charity, you're probably going to give them about $30,000 after, maybe even less after payment of taxes. But if you take that same $50,000 and you give it to charity, they're going to sell that and the charity doesn't owe any tax. So you've just made a $50,000 gift that's going to stay whole. And you can now take that $50,000 deduction and offset your other taxes with it. So it really is a charitable giving and giving what we call in kind, giving assets before you sell them is a really, really effective way to do charitable giving. Two other kind of classes of types of assets we see. Right now, we're seeing a lot, especially with younger folks, of Bitcoin. Bitcoin and what do we call these things? Like Ethereum and all these cryptocurrencies, right? I'm working on one right now for a gentleman who wants to do a large gift of Bitcoin. It's raised in value tremendously over the last few years, and it's complicated. The reason it's complicated is it has nothing to do with the tax law. It just has to do with how do you gift something that doesn't really exist in the physical world? It's a hard thing to gift. So a lot of charities aren't used to figuring out how to accept those kinds of gifts. And that's what we're running into on that end. And the other thing is artwork or tangible property. So sometimes people have things of great value, and maybe their kids don't want them, or they don't want their kids to fight over them, and so they make a gift of those things to charity. On that one, I would always reach out to the charity ahead of time to make sure that it's something that they want to accept or that they can or have the ability to accept. So Martha, I'm going to hand it back to you. Did I miss any of the kinds of assets or any other ones that you can think of that are worth mentioning here?
I think that seemed like a good coverage. So
Okay.
I want to kind of end our talk here at Charitable Giving with one unfortunate pitfall that I learned about a number of years ago. So if you set up a charitable gift that's going to take effect in the future, make sure you talk to someone at the charity like Catherine, someone in the development office so they know about the gift. I'm aware of a gift that was made a number of years ago to take effect at somebody's life. This was set forth in their trust. And the specific gift was a very valuable piece of real estate. And lo and behold, the successor trustee turned around and within a couple of days or a week or so, sold that very valuable piece of real estate to his good buddy at a very, very reduced, way below market price value. I think this ended up in litigation, and I think the charity ended up getting the benefit of that gift. But it's much easier to avoid these kind of, this was just pure malfeasance. It's much easier to avoid having that happen than try to clean it up after the fact. So if you do make a charitable gift or even of any sort, whether it's a bequest or any of these other more complicated structures we've been talking about, make sure that the beneficiary charity knows about this. And hopefully they would be in contact with the successor trustee very promptly so that this sort of malfeasance can't happen. But
oh, sorry, go ahead, Martha.
No, that's all I was going to say.
I just wanted to add one thing to make sure if you're doing or thinking about these gifts, make sure you bring in your family to the discussions. They don't have to be the decision maker, but I did have one case a few years ago where a woman left her house in Atherton to charity, which was a wonderful gift. And it was to promote, social justice and peace initiatives all over the world. And you can imagine a house in Atherton has a lot of value. And so they were able to do a lot of good, but she never told her kids that she was doing that. And so when she passed away, it came as quite a shock for those children to learn that, the house was not theirs. It was going to charity. And so it caused a lot of discord within the family, and it was really too bad. It was something that was so beautiful and wonderful, and then it sort of caused a lot of fighting afterwards. So it's really important to bring your kids and your family into that after you've made that decision. So.
Well, I think that was all, we didn't go into a lot of details, but that's the overview of what Tim and I wanted to present. So I guess if there are questions now.
Thank you, Martha and Tim. This is so fascinating and informative, and you've just made it a really wonderful overview and made it so accessible and lucid. I've really enjoyed listening to you talk. We do have some time and some really interesting questions, and I will, if you don't mind, share some of them with you.
Can I just respond to that? For a lawyer to be told that what they've said is very lucid, it's a high compliment. So
that's right.
Thank you, Tricia.
One question is, what are the tax benefits and liabilities of donating depreciated assets to charities?
You want to take that one, Martha?
That's not something we think about much in this context. It really is so dependent on what the donor's tax situation is, what their asset situation is, and best to take up with their tax advisor or their attorney. I would tend to think that it's probably not. You maybe get more tax benefit by selling the asset and taking the loss deductions.
Yeah, and it depends on what the reason for the depreciation has been too. So we've had some clients where we've been brought into situations where people have given assets to charity that have depreciated, and the reason they depreciated was, for example, in real estate, like there was environmental concerns or things about the property itself. And in that case, sometimes the charity's better off not taking it, or maybe they're prohibited from taking it. So if you have a depreciated asset, it is, I think Martha's right, you talk to your tax advisors and figure out if it even makes sense to give that to charity, or if it makes better sense to sort of sell it first, take the loss, and then give the proceeds to charity.
Thank you. Another question from the audience is that you have talked about estate taxes, and I think this is a pretty big question that might be for another day, but it's out there regarding what are the current estate tax thresholds.
You mean today or yesterday or tomorrow?
Yeah. Everybody's seeing this in the news, and I actually, right before we came on, I looked to try to see if there was any updates from Congress, because our clients are always asking us what's going on. Right now, the current state of the estate tax exemption, we call it, the amount that you can leave to your kids and others tax-free, is up above 11 million. It's 11.7 million for 2021. And I think they just came out with the new inflation numbers, inflation adjusted numbers for 2022. And I think it's 12.1 or 12.2 million.
12.06 to be
precise.
precise.
06. Okay. So it's a pretty good jump though, from 11.7 to 12.06. So those numbers are going to go down. According to the current law, it sunsets at the end of 2025. So in January of 2026, roughly it'll be cut in half. So that's about think of it of about $6 million of exemption in 2026.
Trisha,
Yes.
I don't have a question, but I'd love to underscore for everyone watching something that both Tim and Martha have alluded to or said directly, and that is how valuable it is for Grace Cathedral to know about donors' plans and how much that helps the staff actually working on the gift when it matures to know, what your intention was when you made your plans and how to, and often cases bring the community around that donor together around how, special that commitment is and the kind of impact it has on the cathedral. So I loved when you said it really helps the cathedral to know. Tim and Martha probably know this, and Trisha, you might know this too, but it's there's actually, I've heard a couple of percentages, but I don't know if it's current anymore, but the vast percentage of planned gifts that are made are never known to the charitable institution until they're made. And there's something really lovely for the institution to know while the donor's living and actively planning so that we can honor the gift appropriately.
It's a great point. Let's see, I want to make sure we get to other questions that have been raised. One more question is it possible to give a gift through one's estate plan now, or do I have to wait until I die?
Well, my answer is no, you don't have to wait till you die. Several of the options we've outlined, in our talk are about gifts that can be made during your life, either the gift annuity, charitable lead trust, and another aspect of the giving IRA or retirement beneficiaries is that you can give directly from your IRA to a charity during your lifetime. You can make your the amount that is the required distribution. You can direct that to charitable organizations. Now it's kind of a wash if you do that, because if you took your required distribution, you get it, and then turned around and made a gift to charity, you get a charitable deduction for the gift. It would make sense to do that, to make that lifetime gift of IRA distributions, if receiving that required distribution will bump you up into a higher tax bracket. So this can be kind of, you need to kind of talk with your attorney or your accountant about precise effects of this, but no, you certainly don't need to wait till you die to give money to charities. There are a lot of different ways to do that. Em, did you have any thoughts?
No, the only thing I would add, I think, is sometimes people want to be charitably inclined or give charitably, but they're not sure if they can afford it, right? They don't know, I might need these assets, or I might need that income. And for that, the gift annuity and the charitable remainder trust are great options, because you can put money aside for charity, and then that those annuity payments are coming, so you know that you're gonna continue to receive income for your lifetime. I have a few clients, quite a few, who have set those up and then decided, I don't really need this income. And so they'll turn around and give that income back to the charity each year. Or they'll decide year in, year out whether they want to keep it or not. Or I just had one where the guy said, I definitely don't need this income. And he just gave the whole amount. He terminated the trust and gave the amount to the charity before he's deceased. I mean, he's not an old, he's a young guy. So yeah, so it's always a constant kind of calculation of, can I afford to give this to charity now, or should I wait until I'm gone?
But that is a good, when my clients talk about making current gifts, maybe even to their kids, I do encourage them to make sure that their own needs are adequately taken care of. Of course, planning for the future, which is so uncertain, is difficult, but people, clients, whoever who are thinking about making gifts should make sure that their own needs for the future are taken care of first. Because if you give your money to charity, maybe they'll be there when you need something, but probably not. So you need to take care of yourself first. Anything else, Tricia?
I see we've almost reached the end of our time, and I'm just, again, so grateful to you, Martha and Tim. Catherine, thank you so much for doing this. And let's see, we have some contact information I'd like to share, if we could put that up on the screen. Thank you so much for sharing your lunch hour with us, to our friends who are here with us. And if you have more questions about our planned giving society at Grace Cathedral, please do reach out to us, the development department at Grace, or come to our website to learn about Circle of Grace. And if you have follow-up questions about estate planning in general, please do contact the offices of Tim Watson or Martha.
Thank you so much. It was great to be here with you guys for this time.
Thank you all for joining us here.
Yeah, thank you for everyone for being online with us, and for taking the time to learn more, and to all of you, especially our trustee Tricia, for organizing us today.
Bye-bye, everyone.